So you want to own a bank. It sounds like the safest business anyone could possibly own. You're the one holding everybody's money. People line up to hand you their savings, you keep some in a vault, you lend the rest out at interest, and you sit in the middle of the whole economy skimming a little off every dollar that moves. What could be more solid than being the place money lives? Now here's what should terrify you. In March of 2023, a bank that had existed for 4 decades, the 16th largest in the entire United States, was perfectly fine on a Wednesday and legally dead by Friday. The whole collapse took about 44 hours. In a single day, customers tried to yank $42 billion out of it, roughly a quarter of everything the bank held. And the thing that killed it wasn't a robbery, wasn't fraud, wasn't reckless loans to people who'd never pay them back. It died because it did the most boring, safe thing a bank can do. It bought government bonds. By the end of this, you'll understand how the safest-looking business on earth is secretly the most fragile, how a bank quietly conjures money out of nothing every time it makes a loan, and why the thing that destroys a bank is never the vault, it's a feeling. Because a bank is not really a place where your money sits waiting for you. It's the most leveraged bet in the entire economy. A bank runs on a thin sliver of its own money and an enormous mountain of everybody else's, lends that mountain out for decades at a time, and stays alive for exactly as long as the crowd believes it will stay alive. The only product a bank actually sells is trust, and trust is the one asset in the world that can evaporate in an afternoon. Let's start with getting in the door, because it's harder than almost any other business on earth. If you want to build a brand new bank from scratch, the industry calls it a de novo bank. The government makes you raise a serious pile of money before you're allowed to take a single deposit. The floor is usually at least $20 million of your own capital, and in a market like New York City, regulators expect the number to start north of $50 million. Then you write a business plan, often hundreds of pages, projecting every loan, every cost, every risk for your first 3 years. Regulators study it for something like 18 to 24 months. And even after you open, you spend 3 years under heightened supervision, examined constantly, forbidden from straying from the plan without permission. It is so slow and so expensive that almost nobody does it anymore. Between 2000 and 2008, roughly 150 new banks opened in America every year. In 2023, the number of brand new banks was 6. In 2024, also 6. An entire nation of 330 million people, minting about half a dozen new banks a year. So most people take the shortcut and buy an existing bank instead. Skip the 2-year wait, inherit the customers, the branches, the staff, and most importantly the license. Small community banks tend to trade for somewhere around 1 to 1.5 times their book value. Because what you're really buying, either way, is that license, arguably the single most valuable permission slip the government issues. It's the legal right to take other people's money, and as you'll see in a moment, to create money that didn't exist a second earlier. And here's the first number that tells you what kind of machine you've actually bought. From the day it opens, regulators only require a new bank to hold about 8% of its assets as its own capital. Flip that around. For every dollar of the owner's money, the bank is carrying somewhere around $12 of other people's. You are not running a business that's mostly funded by you. You're running a business that's mostly funded by your depositors, and your own skin in the game is a thin cushion on top. So how does this machine make money? It comes down to one idea, and it's stranger than it sounds. When you deposit $1,000 into a bank, the bank does not stick that exact thousand in a drawer and guard it. In fact, since March of 2020, the Federal Reserve cut the reserve requirement, the amount banks are forced to keep on hand, all the way to zero. Zero. Your $1,000 isn't sitting in a reserve box with your name on it. It's already been lent out. And when a bank lends, it doesn't dig through the vault for physical cash. If it approves a $300,000 mortgage for your neighbor, it simply types $300,000 into your neighbor's account. That money did not exist a moment before. The bank created it, as a keystroke, backed by the borrower's promise to pay it back. The money is destroyed again when the loan is repaid. And in between, the bank collects interest on money it conjured into being. That is the actual engine underneath the whole industry. And once you see it, banking stops looking like a vault and starts looking like a licensed money printer with rules. Now the profit. The core of it is called the net interest margin, the gap between what a bank pays for money and what it charges for money. Picture a customer with $10,000 in a savings account. The bank might pay them 0.5% a year in interest, $50. Then it takes that same money and lends it out as part of a mortgage at 7%, $700 a year coming in. The customer gets 50. The bank keeps the 650 difference on money it never really had to own. Multiply that spread across every account and every loan in the building, and you have the whole business. And it gets even easier than lending. Since reserve requirements went to zero, the Fed steers the economy a different way. It pays banks interest just to park money at the Federal Reserve, lately somewhere around 3.6%, completely risk-free. So a bank can take your deposit, lend you nothing, take zero risk, and still earn a safe return simply by leaving the money at the central bank overnight. No borrower, no default risk, no effort. The machine earns even while it sleeps. The most aggressive version of that spread lives in your wallet. Americans currently owe somewhere around $1.3 trillion on credit cards, and the average interest rate on the balances that carry from month to month sits above 22%, even while the Federal Reserve's own benchmark rate is under 4%. Banks are charging borrowers roughly 5 to 6 times what it cost them to get the same money. Now think about who actually pays that. Nearly half of all cardholders carry a balance instead of clearing it each month. Someone with a $6,000 balance making the minimum payment is handing the bank most of that payment as pure interest and can take the better part of a decade to climb out, paying thousands extra along the way. The bank's most profitable customer was never the wealthy person with a fat account. It's the ordinary person whose paycheck falls a little short and who quietly rolls a balance forward, month after month, year after year. And beyond the spread, there's a whole second layer of income the customer barely notices: fees. Overdraft charges, monthly account fees, ATM fees, wire fees, late fees. Any one of them looks trivial. Collectively, they're worth billions a year to the industry, and they tend to land hardest on the customers with the smallest balances, the exact people least able to keep the cushion that would have avoided them in the first place. Stack all of this up at scale, and the numbers get staggering. JPMorgan Chase, the largest bank in the country, earns around $90 billion a year just from that interest spread, the gap between what it pays for deposits and what it earns on loans. In 2024, JPMorgan posted a net profit of $58.5 billion, the most profitable year any bank has ever had in American history. That is what a fully grown version of this machine looks like when the confidence holds. But that word, confidence, is where everything turns. Because a bank can be profitable, well-run, and completely doomed at the same time. And there are 3 ways this machine kills its owner. The first is the one that took down Silicon Valley Bank, and it's a trap hiding inside the safe choice. That bank took billions of dollars in deposits from tech startups and did something that looked conservative on paper. It bought long-term U.S. government bonds. Then the Federal Reserve raised interest rates at the fastest pace in decades. And when interest rates rise, the market value of older, low-interest bonds falls. That's just how bonds work. Suddenly, the bank was sitting on something like $17 billion of losses on paper, on assets everyone had called safe. As long as it never had to sell them, the losses stayed invisible. But its startup depositors, starved of new funding, started pulling their cash out. To meet those withdrawals, the bank was forced to sell $21 billion of those bonds at a realized loss of $1.8 billion. It announced that loss, tried to raise fresh capital to plug the hole, and that announcement was the spark. What happened next only happens in the modern world. The old-fashioned bank run was a physical line of people outside a branch, which at least gave the bank time to react. This run happened on phone screens. Venture capitalists and founders, all connected through the same group chats, told each other to get their money out, now. In a single day, customers ordered $42 billion in withdrawals. By the close of business, the bank had a negative cash balance of nearly $1 billion. It literally could not pull together enough money to meet its obligations. Roughly 44 hours after the first crack, regulators seized it. A bank that had survived 40 years died over a long weekend. Not because it was insolvent in the old sense, but because everyone stopped believing at the same time. And there was a reason everyone moved as one. Silicon Valley Bank had banked nearly half of all the venture-backed startups in America. Its depositors weren't a scattered crowd of strangers who'd never met. They were one tight-knit community, funded by the same handful of investors, sharing the same chat groups. So when fear hit, it didn't spread person by person. It hit all of them at once. a concentrated depositor base, it turns out, is a loaded gun pointed at your own bank. The second way to die is the opposite problem. Not safe bonds, but bad loans. A bank's assets are mostly the loans it's made, and if enough borrowers stop paying, the bank eats the losses. Right now, the flashing warning light is commercial real estate, especially office buildings. Remote and hybrid work gutted demand for office space, values have fallen hard, and office loan delinquencies have climbed towards 12%, worse than during the 2008 crisis. And here's the part that matters for you as a would-be owner. Small and regional banks are roughly 5 times more exposed to commercial real estate than the giant banks are. Over $1.6 trillion of these loans sit on regional bank balance sheets, and roughly $1 trillion of commercial property debt is coming due and needs refinancing at much higher rates. A wave of half-empty office towers that can't pay back their loans is exactly the kind of quiet crack that turns a healthy-looking regional bank into the next headline. The third way to die is the deepest one, and it's baked into the entire model. A bank owes its depositors their money on demand. You can walk in and ask for all of it today. But the bank has lent that money out in 30-year mortgages and multi-year business loans it can't call back overnight. It keeps only a sliver in actual cash. So no bank on earth, not the healthiest, best-run bank in the country, can survive every customer asking for their money at the same time. The money isn't there. It's out in the world, tied up in other people's houses and businesses. The entire system works only because, on a normal day, most people leave most of their money alone. The moment they don't, the math breaks, and it breaks fast. There's really only one thing standing between every bank in the country and that kind of run on any given morning: a government promise. The FDIC insures deposits up to $250,000 per person, per bank, so most people never sprint for the exits at the first bad rumor. They know their savings are covered. That guarantee is the invisible foundation the entire industry is built on. But look closely at what it actually means. The trust that keeps banks standing isn't really trust in the bank at all. It's trust in the government behind the bank. Take that backstop away, and the honest truth is that a wave of runs could hit the system within a week. Which brings us to the strangest pattern in this whole business: what actually happens when a bank dies. It doesn't just vanish. It gets swallowed by a bigger bank, and the biggest bank gets bigger every single time. Go back to that 2023 panic. Silicon Valley Bank fell. Then Signature Bank fell. Then First Republic Bank, with around $229 billion in assets, the second largest bank failure in U.S. history, fell too, after bleeding more than $100 billion of deposits in a single quarter. And who bought First Republic out of the wreckage? JPMorgan. It took on essentially all of First Republic's $92 billion in deposits and the bulk of its assets. The very same JPMorgan that, back in the 2008 crisis, bought the collapsing Bear Stearns and then bought Washington Mutual, which failed with $307 billion in assets and remains the largest bank failure in American history. There's a rule that's supposed to stop any single bank from holding more than 10% of all the deposits in the country. JPMorgan was already over that line. Regulators waived the rule and let it buy First Republic anyway. Sit with what that means. Every time the banking system convulses, the strongest player is handed the corpses of the weak ones and walks away larger. Banking crises don't shrink the system, they concentrate it. The panic that destroys the small owner is the same panic that feeds the giant. So let's add it all up and answer the real question. What do you actually make if you own a bank? Start with the small version, your own community bank. You raise your 20+ million in capital, plus more for lawyers, consultants, and the charter. Your first 3 years, you lose money. Almost every new bank does, while it builds up enough deposits and loans to cover its fixed costs. By around year 5, if it works, you might be sitting on a few $100 million in assets, earning the spread on all of it, and clearing a few $1 million a year in actual profit. And here's the honest part nobody advertises. Most small banks never grow much past that. You run it steadily for a decade, then sell it to a regional player for a few times what you put in. Respectable, not a fountain. Scale up to a regional bank, tens of billions in assets, hundreds of branches, and you're looking at hundreds of millions in profit a year. But only if you dodge all 3 traps at once. You don't drown in safe bonds when rates move. You don't get buried under bad loans when a sector like office real estate cracks, and you never ever lose the confidence of your depositors for even one bad weekend. And at the very top sits the thing you're really staring at when you look at JPMorgan. About $4 trillion in assets, resting on only around $345 billion of its own equity, throwing off tens of billions in profit a year. An economy-sized machine, built on a thin cushion of its own money and an ocean of everyone else's, held up, at the end of the day, by nothing more solid than belief. So if you ever do decide to own a bank, understand exactly what you're buying. You are not buying a vault full of cash. You're buying the right to run the most leveraged bet in the entire economy, funded almost entirely by other people's money, invested in loans you can't get back quickly, and secured by nothing sturdier than a crowd's faith that their money is safe with you. When that faith holds, it is quite possibly the best business ever invented. And when it cracks, it is the fastest collapse in the world. $42 billion out the door in a single day and a 40-year-old institution gone before Monday. And if you've noticed the pattern by now, a business that looks bulletproof from the outside and turns out to be balanced on one hidden weakness, you've seen it before on this channel. Watch the one on owning a shopping mall next, where a building that looks 90% full can quietly be going broke. Then the one on owning an airport, where the busiest hub in Europe somehow loses money on the planes. It's the same trap wearing a different building every time.